More tariffs would mean lower global trade, potentially lower oil demand, lower oil prices.
For anyone who doesn't know, about 80% of the global supply chain for solar is in China. So they're very dominant in that space already. I know some of the companies we cover do have a little bit of exposure to Mexico. Just recalling that Enphase, which makes inverters, a couple of weeks ago already announced that they were trimming some of their global workforce and ceasing operations in Mexico. You almost wonder, did they sort of envision this coming and they just got out ahead of it?
I know Maxion has historically had solar panels held at the Mexican border, and they yesterday announced that they want to just focus on their U.S. business, and they've sold off their, European and Asian businesses, and they're going to focus on manufacturing out of New Mexico, not Mexico.
I think it's important to note, akin to what Mr. Trump did with China by getting both sides of the aisle to push back on China. Same thing he figured out early on in 2016 that pushing back on Iran in the U.S. is a good way to get votes. Now both sides of the aisle, very much agreement on tariffs, partly because we've proved that things like NATO and free trade with the world's largest demand pull economy and the world's global base currency just doesn't work. And that's what the key point of Robert Lighthizer book. There's no such thing as there's no free trade. And that's got to be offset with tariffs, because when you have the largest demand pull economy in the world, the biggest, easiest place to sell, and you want to sell product to a country like China, you can't even trade their currency open. And it just doesn't work. And it hasn't worked. And we're proving this. So it's going to change. And the bottom line is you have to start with China.
Good morning, good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. I'm figuring we've got a more European or non-US focused crowd today, given tomorrow is Thanksgiving here in the US. But let's see, on the call from our side, we've got Salih Yilmaz joining from his usual perch in Dubai, swinging over to London. We've got Alessio Mastrandrea joining, and in Washington, D.C. today, we've got Mike McGlone also joining. And so just looking quickly at the commodity screen here, Brent crude's in the low 70s per barrel today. Henry Hub's just over $3 per MMBTU. And not that we're going to focus this call completely on politics, but I will note there has been a lot of discussion kicked off by incoming President Trump about the idea of tariffs against Canada and Mexico. So, Mike, let's come to you first. If the U.S. were to actually impose 25% tariffs on our northern or southern border, what do you read of it? Is this how would it affect energy markets, and how would you frame the potential for tariffs? Is this just bluster? Is it a negotiating tactic, or is this something that could actually come to reality?
First, I think it's absolutely not bluster for two key reasons. One is the book, There No Trade is Free by Robert Lighthizer, the former trade representative. He pointed out, this was well before he wrote this book last year, Trump was elected, that this is what's happening is something that some people in this country have been waiting to do for decades, including myself, being with clients, talking to clients 30 years ago. Just let's stop this. Everybody wants free trade as long as they can have a trade surplus with the U.S. So that's happening, and you got to get it over with right away. And that's the mantra. Also, I'm hearing that from Nathan Dean, my colleague, Washington correspondent, who I sat down with yesterday. The difference, I think, is the primary focus is China, number one. And then Europe, number two, an ally. China is obviously an adversary. They made themselves that. And what you're seeing right now, I think, is more trial balloon between the U.S.-Mexico Canadian trade agreement, which Lighthizer and Trump administration really did well with establishing and pushing back on the North American trade agreement back in 2016, 17, and 18. So I think it's more trial balloon. In fact, Mr. Trudeau and Mr. Trump have already hooked up, and there's actually a bit of a bromance there. So I think it's trial balloon there. But the bottom line, from my standpoint, in the U.S. is we have a massive excess of supply and getting bottleneck supply of liquid fuels, petroleum, natural gas, and grains, and that's particularly corn, soybeans, and wheat. We have to export. If we don't, prices will go down, and they're already heading lower. So this, number one, this Trump's administration is coming with tariffs at a time that there's already a pre-existing trend lower. So if we had some trade tensions, it's going to maybe limit some of those exports. But the bottom line too is also what's happening with China, and we see the diminishing demand from China in crude, and I think my colleagues can point that out, and certainly in imports, and diminishing demand for diesel across the world, most notably in the U.S. So it kicks into my view that we're still going to see lower prices in the U.S. I think the average price of gasoline in this country, which is $3, is going to go to $2. It's not profound. It always does, and we have to export gasoline from the U.S. That's an oxymoron compared to the last 30 years of history. And even diesel. I mean, the demand is probably going to continue to decline, and supply is going to continue to increase. Just look at biodiesel. We said it's starting to increase, and we see massive excesses of supply of ethanol in this country because we have a superabundance. Why? Number one is on the back of that big pump in prices. Elasticity kicked in, and now we're heading towards that lower trend. So I think you should believe what's going to happen. Should get those tariffs done right away. And here's part of the political reason. In 2 years, we have the midterms, and often the U.S., you almost always switch back a little bit. It's just a check and balance. Right now, there's a red sweep, so now's your time. Get it over with, rip the Band-Aid off. And then in 4 years, it's thinking about legacy in the future. So I think Mr. Trump, and it's the psychology and the human nature of what we have done here in this country. We've shifted over to complete Republican sweep. There's massive and drill at will, and it's already a pre-existing trend. Now, so I'll end with this. The average cost of production, break-even costs for WTI in this country is $56 a barrel, according to Bloomberg New Energy Finance. I think, Salih, you do some work on that too. And basically, history is an example. You got to get below that price to shut off that excess supply, increase demand. We've already done it in U.S. natural gas, and we're heading there in grains. Corn's low is right about its break-even cost. Iron ore is already broken down, and the last one for me is a broad commodity guy is copper. If copper continues to break down, that's the whole complex heading towards deflation. And if U.S. stock, and then there's this inordinate burden, the U.S. stock market has to stay elevated, and we haven't had a 10% correction in over a year. It's overdue for that.
Okay, Salih, let's get your perspective on this. I believe the last time we had you on this call, you did speak about the idea that tariffs could be a general headwind.
Thanks, Rob. I think the part of the initial bearish reaction to Trump's election win with oil prices was partly driven by the potential impact from tariffs, because more tariffs would mean lower global trade, potentially lower oil demand, lower oil prices. But as you said, this was more on the global trade, not necessarily on.
Let's get your perspective on this. I believe the last time we had you on this call, you did speak about the idea that tariffs could be a general headwind for oil prices as you were kind of looking out into kind of 2025. I don't think you were specifically commenting on the idea of tariffs between U.S. and Canada or U.S. and Mexico. I think it was more sort of just a general idea. But how do you read the impact that these kind of policies could have on the global oil market?
Yeah, sure. Thanks, Rob. I think the part of the initial bearish reaction to Trump's election win with oil prices was partly driven by the potential impact from tariffs, because more tariffs would mean lower global trade, potentially lower oil demand, lower oil prices. But as you said, this was more on the global trade, not necessarily on Canada. And I mean, I haven't really written anything on specifically on these proposed tariffs on Canada, but I mean, these could include 4 million barrels per day of Canadian crude imports into the States. So this in itself could result in higher gasoline prices and energy costs for U.S. consumers, and that's kind of the first thought that comes to mind. But yeah, I mean, I don't know if that's been one of the major drivers. I mean, we've been watching the upcoming news around the upcoming OPEC Plus meeting that's scheduled to take place on Sunday. We weren't sure if it was going to be an in-person meeting in Vienna, because the last couple of meetings were changed to an online-only meeting, and as expected, this was switched to a virtual meeting as well. And the news there have been relatively bullish in the sense that it looks like, once again, they will be delaying their planned output hike from the end of December to by at least a month, we think, but probably more likely by a quarter. So we're watching that, and I think that's kind of the bullish part of some of the movements that we saw, and that's been against the potential ceasefire agreement between Israel and Hezbollah, which is something that we're watching very closely as well. But yeah, the point on tariffs, we were looking at that in terms of the initial price reaction to Trump's election win. Now with Canada, perhaps contradicting potential oil price impact. But then for general oil price movements, what we're watching right now is the OPEC Plus meeting that's going to be on Sunday, but it's very much possible that we get an indication of what the result of that meeting would be before Sunday, and then also what happens with the ceasefire talks between Israel and Hezbollah. Very important, and we are watching that in the next couple of days.
Fantastic. Okay, Alessio, I want to bring you into the conversation. So to maybe shift and think a little bit about tariffs' impact on the clean energy landscape. So if for anyone who doesn't know, about 80% of the global supply chain for solar is in China. So they're very dominant in that space already. I know some of the companies we cover do have a little bit of exposure to Mexico. Just recalling that Enphase, which makes inverters, a couple of weeks ago already announced that they were trimming some of their global workforce and ceasing operations in Mexico. You almost wonder, did they sort of envision this coming and they just got out ahead of it? But you tell me, kind of, do you see tariffs as having a major impact on wind and solar space, and kind of how do you think about the role that this kind of policy could have there?
Yeah, so it might have been a kind of a tea leaf situation with Enphase. I know Maxion has historically had solar panels held at the Mexican border, and they yesterday announced that they want to just focus on their U.S. business, and they've sold off their European and Asian businesses, and they're going to focus on manufacturing out of New Mexico, not Mexico. Ironically, Canadian Solar doesn't produce out of Canada. They just have their headquarters there. They have 2 sites in the US. And as you said before, obviously Enphase has decided to pull out of Mexico. As far as tariffs go, the 2 things we're really looking at is the manufacturing credits under the Inflation Reduction Act and offshore permitting for wind. As far as the manufacturing credits go, 75% or more of these factories that have been built post-IRA are actually built in red districts. And as far as offshore permitting goes, the IEA predicts that the wind build out through 2030 is going to be about 300 gigawatts. 10% of that is going to be offshore. And there's about 20 gigawatts in the permitting stage, which might be affected by Donald Trump because he's been a very vocal detractor of offshore wind. But it is worth mentioning that Joe Biden has spent $1 billion to expedite this permitting. So maybe we'll get that into more advanced stages and we can still hit that 300.
Okay, very interesting. Mike, I want to come back to you with a philosophical question on just the idea of tariffs, because it's almost ironic to imagine that we've got a Republican president and a Republican Congress advocating for increased tariffs. I think if you tried to show this to someone 20 years ago or 40 years ago, they'd think you were out to lunch. They wouldn't understand what the heck you were talking about. And so I'm curious, so now that this does seem to be a sort of popular ideology within the Republican Party, maybe Democrats may also swing that way as well, because I think Harris was also generally supportive of at least certain kinds of tariffs. So when you think about how this may affect commodity markets in general, if we have higher tariffs, does that ultimately lend itself to more self-sufficient production and consumption within a country? Will the U.S. export less energy as a result of these, more energy? I mean, we've become a behemoth in LNG recently. So how does this play into something like LNG exports in your mind?
So I appreciate the question. I think it's important to note, akin to what Mr. Trump did with China by getting both sides of the aisle pushback on China. Same thing he figured out early on in 2016 that pushing back on Iran in the U.S. is a good way to get votes. Now both sides of the aisle, very much agreement on tariffs, partly because we've proved that things like NATO and free trade with the world's largest demand pull economy and the world's global base currency just doesn't work. And that's what key point of Robert Lighthizer book. There's no such thing as there's no free trade. And that's got to be offset with tariffs, because when you have the largest demand pull economy in the world, the biggest, easiest place to sell, and you want to sell product to a country like China, you can't even trade their currency open, and it just doesn't work, and it hasn't worked, and we're proving this so it's going to change. And the bottom line is you have to start with China, and let's look at the history of what happened with, it's an economist who wrote this. He said in the last 100 years, if you wanted to become wealthy as a country in the world, you cozy up to the U.S. China did that. U.S. and China did that partly as a pushback in the Cold War. Now, Mr. Z made the major mistake in history of pushing back on the U.S. and cozying up with Russia. So you see the shift there. And said, I remember this being, I was in China the first time 15 years ago. It reminded me very much of Japan. Now, Japan's GDP at $3.2 trillion is the same as it was 30 years ago. That's happening in China now, except Japan never supported, it was never a decisive enabler, according to NATO, of a war in its best customers' background. So the backyard. So to me, that's historic what's happening. It's a pushback on China. It's a reversion of a rapidly advancing emerging market. It means major pressure on commodities. That's why I always head towards copper, because China and copper belong in the same sentence. But in the bottom line for tariffs, it means any type of trade war means the massive, I wrote about this for a few years now, that if people who are bullish commodities need to blame good old America, not only because of the strong dollar, because of the massive increase in excess supply of energy and in grains and food. And that's happening right now with this paradigm shift of the tariffs finally starting to kick in. So I look at this as going to be a normal correction of commodities, which means it's going to accelerate my initial view that crude oil is going to get to 40 before it really bottoms. You got to kind of offset. Corn's going to probably get to a 3 handle, soybeans probably to an 8 handle, and copper is the key one. And the question is what stops it? And typically you need some kind of shocking supply shock, which would just be short-term and tilt it lower. And that's what happened with Russia's invasion of Ukraine. It was a supply shock that tilted the forces lower, or some kind of massive shift in global geopolitics where Mr. Z wakes up one morning and says, Vlad, sorry, unlimited friendship is not working out. We're going to be friends with the U.S. They're the best place in the world to export our products, and we're an export economy. Yeah, right now, good luck. So that's why I stick with, from a commodity standpoint, philosophical, historical. I can mention a dozen books that point out this is normally what happened. One key book that really kept me bearish crude oil is The Price of Tomorrow by Jeff Booth. Just pointing out how technology is moving so fast. Why is Bitcoin somewhat demonetizing gold? Technology is moving so fast. Why have we using more and more, creating more and more supply of petroleum and using less every day? It's technology. And another book was A Domino Effect by Brazier, I think was his name, just pointing out how the technology, you drill one well, and you can put out fingers of horizontal wells for going 4 miles and put out dozens of them. It's just, the technology is overwhelming. So I look at it as, this is just a normal deflationary cycle we're kicking in. And the question I keep asking myself is what stops it? And so I mentioned a few things that might stop it. I'm afraid come next year, we're going to see pretty severe deflation, which is normal when you get a base effect of inflation and you just revert. And that's what we're starting to do. And the one key thing that hasn't gone down is U.S. stock market. So look at bond yields in China, 2.06% is the 10-year yield. The U.S. 10-year yield is at 4.27%. That's a major disparity. It's probably going to narrow, which means U.S. is probably going to go lower. And you see it, I'll end with this. When you're dependent on what Salih said, you have to have continued cuts in normal supply from OPEC. You have to continue to increase that spare capacity. And you have to depend on fiscal and monetary stimulus in China. Just the fact you have to say that shows you the tilt. And the tilt is, my base case for next year is we're going to get a normal 10% correction in the U.S. stock market. Bond yields in the U.S. are going to drop a lot, and deflation is going to result, which is normal historically after the inflation. And that's one thing the market's not priced for. That's why, as a commodity person, that's what I'd be looking to trade. And that's one thing about commodity people. You always best being a bit of a contrarian, because one thing we learned, commodities, not like stocks. Stocks go up because they went up, and commodities go down because they went up.
I love it, Mike. You've got such an elegant way with words. Okay. And I will just say, Alessio, we're going to come to you in a minute and talk about deflation in solar and wind, because I think, if you're thinking about deflation in traditional energy commodities, the parallel and the impact of technology is way more profound, perhaps when you start looking at some of these new energy technologies. But I want to come to Salih first. I want to square the loop here a little bit. So when you think about 2025, I'm curious, because you brought up geopolitics, you brought up the conflict in the Middle East. We've got Russia, Ukraine. We've got these sort of big geopolitical uncertainties still floating around out in the world. And we've got this idea about technology influencing markets, as Mike was just talking about, and ideas around deflation. So give me a sense, how is geopolitics going to weigh on the global oil market in 2025? I think it was a big theme. You've got a deep dive that you put out for earlier this year. Are we going to see the same kinds of geopolitical forces influencing the markets? And so what are the factors that are really going to shape 2025 in your mind?
Sure. I mean, I think it's a very good question, and you're right. Geopolitics, in the context of the oil market, have been dominating headlines for the majority of this year. But that being said, arguably the geopolitical risk premium on prices has actually not been that great. It's been limited even during times of heightened uncertainty, heightened tensions, especially in the Middle East. One thing I should say, and I mean, you've alluded to this, is perhaps when we said geopolitics, many people would have thought the conflict in the Middle East for majority of this year. I mean, in the last 24 hours or so, it looks like we're going to get a ceasefire between Israel and Hezbollah. So my expectation is that when we talk about geopolitics next year, it might be more around the Russia-Ukraine conflict and around Iran, more than the Hamas and Israel-Hezbollah conflict. And I do think we will continue to talk about it. It's very difficult to quantify, as I said, the actual risk premium that is on prices. We will continue to attempt to do it, but it's always very difficult. But I wouldn't be surprised if it remains negligible, because what we've seen for most of this year was that geopolitical risk may have been high, but the market was very hesitant to price that in unless there was actual disruption to oil flows. And we actually haven't seen a lot of disruption to oil flows, despite all the escalation and despite all those risks. So looking at next year as well, unless we get an actual disruption to oil production or oil flows, I suspect that the geopolitical risk premium will remain below $5 a barrel, probably below $2 a barrel. So I think that's one. I mean, beyond the geopolitics, kind of the market fundamentals, obviously very important. To Mike's point, I mean, it looks like I mean, as things stand, we might actually have an oversupplied market next year. The IEA thinks even if OPEC Plus doesn't change its current policy, even if they don't add any new barrels to the market, we will still be in a surplus, which actually leaves OPEC Plus in a very difficult position, because demand has been very underwhelming this year. It might be underwhelming again next year. There's a lot of supply from outside of OPEC Plus, so they're now in this challenging position of trying to decide what to do next. And essentially, what they've had to do, as we know, is just kick the can down the road, delay these output hikes, and I think they may have to do so. So beyond the geopolitics, I think it's very important to look at the market fundamentals, which are still looking quite soft for next year.
Okay, very interesting. So if you think the oil market might be oversupplied, whatever. I don't know if you gave a number, but let's say it's 1 million barrels a day, whatever. It's something like that. Let me give you a stat for the solar industry. The solar industry installations or demand this year is going to be about 600 gigawatts. Massive number. 600 gigawatts is a very profound number. But the world, if all the factories that could make modules were sort of running at full tilt, you could make about twice that amount, 1,200 gigawatts. So big oversupply in the solar space. That's probably not going to be worked off next year. But Alessio, I want to come to you and can you help frame the kinds of deflationary pressures because of that oversupply and other factors, how we've seen that playing out in the wind and solar market? What have module prices done? What have polysilicon? Take us through that narrative over the last couple of years of what we've seen unfold there.
Sure. So it's pretty staggering to think that it took until 2022 to have a global capacity of 1 terawatt, and now we have a capacity to do that now annually. But what does that mean for prices? Well, currently modules are trading at or selling for 9 cents a kilowatt. That's mostly in China. As you said before, 90% of the supply chain is based in China. In the US, that's closer to 30 cents. That's what First Solar sells for. And polysilicon is down 40% just this year, and it's selling for $4.50 a kilo. When you kind of factor in Western makers like Wacker Chemie and OCI, that number is closer to $22 a kilo, but it is very cheap. We're seeing similar things happening to solar as you're seeing for wind, where the manufacturers are selling close to cost and then making the money back on the servicing side. We might see some cannibalization of a lot of the major Chinese players if they can't preserve their margins.
Yeah, very, very difficult time to be in the solar module business unless you're perhaps protected by the tariff regime in the US or the Inflation Reduction Act. First Solar is the company we constantly sort of circle back around to and point out and say, hey, they're a little bit different than everybody else. And we've got a focus idea on that company. I encourage you to check it out. And it basically lays out the case about very difficult operating environment for some of these very scaled up Chinese module manufacturers. But First Solar is not subject to the same set of conditions. So let's just close the loop on a couple of research items here from each of you. Mike, I want to swing back around to you, and you've got your energy outlook out. I'll just say the title here: Start of Winter Natural Gas Spurt or More, Energy Bear Market. So give us a sense, just read the tea leaves for us based on some of your recent thinking. How do we get through the winter, particularly on the gas side? Because I'm going to tie that into a new launch of a company that Salih recently put forward.
Well, I appreciate you going there because I have a clip in my outlook from Salih. The headline is Oil Market Faces a Potential Surplus in 2025. And I also have a clip from our colleague Vince Piazza on gas, and just pointed out the gas, a U.S. focus right now. Overall storage in this country is about 3% above last year. And every beginning of the year, you always get these little scares. And I do like to point out we do have global warming happening in the winter too. So you have to anticipate the trend to reverse, maybe a colder than normal winter for gas to really stay above where it is now. Otherwise, U.S. gas is going to do it's one of the most autocorrelated, high volatility commodities. And if it can stay above these levels, maybe get near 4, they bring on gas fast. Now, demand's going to actually pick up again, but it's only around 20%. It goes down to 2, and it barely gets above 4. That's usually what happens with commodities and typically natural gas. So I don't see what it's going to really keep it going. It's also a thing you learn in grains. You always pump up prices in May as you have the risk of drought, and then they collapse towards the end of the year, towards you get to harvest. Natural gas is the same way right now. And I remember in the summer that January contract was pumping up near 4. Like, it's going to 3. Market was just way too long. Speculative excesses in managed money net futures, net positions. Now they're a little bit short, which has for a little while. So once they get off those shorts, I think it's more likely to see what normally happens with gas. You get past that spurt, the trend in warmer than normal winters continues, we get less demand, and then of course kicks into your space. We're seeing a lot more demand for electricity, but overall for natural gas, it's still about winter heating season, particularly now. And then by the time you get to December and we realize it's kind of warmer than normal and you don't have to wear your hats and gloves, and for me, it's always got to have a hat with a head like this, then it's just what it normally does. So that's why I point out, I think natural gas is going to go back, is more likely to go back to 2. The January contract last year ended at 262. It stops trading in December, and right now it's closer to 3 and change. And it might spurt to 4. I think it's more likely a backdrop towards that January contract that expired last year at 262. And overall, again, inventory is a little bit higher than they were last year.
Mike, I'll just observe, sitting there in Washington, D.C., it looks like the temperature's in the mid-50s. It's 80 back in sunny Miami, where you're coming back to warmth soon, I presume. Salih, let's swing around to you. You recently initiated on a new company for your coverage, ADNOC Gas, and I'm curious. Mike's got a bearish view on the sort of commodity fundamental for the short term, at least looking through winter, it sounds like. How do you think about a company like ADNOC Gas, and help us frame kind of who they are and what you think their medium term outlook looks like for a company like that?
Sure. So this is the natural gas and LNG arm of ADNOC. ADNOC being the national oil company of the UAE. The majority of their production is crude oil, but natural gas is growing in importance for the company's strategy. They don't just want associated gas, they want to increase their production of non-associated gas, and they want to be a bigger player of global LNG. But this company is quite interesting, and it perhaps in similar ways to other subsidiaries of ADNOC, within the UAE, they benefit from very favorable kind of regulatory environment, very favorable feedstock structure that essentially gives them a pretty good margin profile. And they do have this profit sharing agreement where, when things are good, they have to pay ADNOC a little bit more, but when things are not so good, they have that downside protection, which essentially reduces their exposure to market volatility. And I think generally with commodities businesses, but especially with natural gas and LNG businesses, volatility can be quite extreme. So this really allows them relative stability with their profitability and cash generation. But I think the key point for me when I was researching this company was that it really seems to be offering this mix of defensive features like utilities, but then at the same time, ADNOC having this new natural gas strategy, trying to grow and expand their gas business. This utilities type company is also offering significant growth characteristics, which is not something that you normally see from a utilities company. So they have their EBITDA that's expected to grow by 40% by 2029, which also means they have a big capex cycle on the horizon in the next few years. And obviously, when you do have these big capex cycles, execution of it is quite important. So that's what we're watching. But at the end of the day, they have an EBITDA margin of 30 to 35%. It doesn't seem to be, fluctuating too much from that range, which is pretty strong. Again, I could go on to explain the company, but I think the summary of it is that it's essentially a pure play on natural gas. Because they're so big in the UAE market, it gives a good exposure to this growing UAE market. But also, it's also a future kind of play on a growing LNG market as well. Generally a pretty interesting company. And I should say the reason we're covering these ADNOC subsidiaries separately is that ADNOC decided not to list the whole company like Saudi Aramco did. Instead, what they've done is they've listed their fuel retail arm, ADNOC Distribution, the gas arm, ADNOC Gas, logistics, drilling, all separately as separate units. So anyway, if this is now published on a terminal, you can run the ticker ADNOC Gas on your terminal and run BCO, which is the shortcut to all our company primers on these companies.
Yeah, fantastic. Thanks, Salih. And thanks for mentioning the function. We cover roughly 2,300 companies at this point. And so anytime you have a ticker loaded, type BICO to get a sort of snapshot, a view from the covering analyst at Bloomberg Intelligence to see, what they think about the fundamentals of the company. So the big distinguishing factor between us and the sort of traditional sell side is we don't do buy, sell, hold recommendations, but we do take a view on the company, and we certainly take a view on the fundamentals of the company. With that in mind, Alessio, let's come over to you, because similar to Salih, you've been in the process of ramping up coverage this year, and you've recently launched on a couple of names. So give us a quick snapshot of some of your new coverage and how you're thinking about some of the additional names in the solar space that we're covering now.
Yeah, so the first one we looked at was Array Technologies, and what they do is they produce solar trackers. So if you have a utility scale solar field, it helps the solar panel act like a sunflower and follow the sun and get a greater load factor, but it also, in the event of hail, it allows you to turn the angle so they're less impacted to damage. Array has been a big benefactor of the Inflation Reduction Act. They have 31 US-based factories, and it's helped gross margins rise from 12% in 2022 or 14% to between 30 and 35% this year and next year. The second one we looked at is Shoals, which has not released yet, but I'll give you a quick preview. Shoals created its own kind of subsector of the solar manufacturing supply chain. They do EBOS, electrical balance of systems, which is basically just the electrical components. And their unique selling point is that they can help these utility scale developers install faster. Even at the minute, solar is the fastest sort of energy to add to the grid. It takes about a year to install solar panels. This just makes it a little bit faster. And they are not impacted by the Inflation Reduction Act. Nevertheless, their gross margin is about 40% because of the value add that they give to these developers.
Okay, fantastic. So make sure to check out all of the great research that not just Alessio or Salih or Mike publish. It also works for commodities. So if you've got a ticker loaded for Brent crude or natural gas, BICO also will load our view on that commodity. I suppose the acronym slightly different. So Bloomberg Intelligence Company Outlook, Bloomberg Intelligence Commodity Outlook. Nice how that acronym works across both companies and commodities. So make sure to check those out. We're going to hold these calls for the next 3 Wednesdays. So December 4th, December 11th, December 18th. Make sure to join. We'll be talking about our 2025 outlooks across various team members. And then we'll resume in January, on January 8th. January 1st is, we'll take that one off. And January 25th or December 25th, we'll also be taking that one off. So look forward to being in touch. Feel free to reach out to any of us if you have follow-up questions or you want to talk more deeply about these topics or any of our research. Take care, everyone. Look forward to seeing you next week. Cheers. Happy Thanksgiving to folks in the U.S.